So if I go back to let's close this one up. So that's the videos. So if I go back, see if I go to the the textbook directly, would it be helpful for me to go ahead and go through chapter 12? See if I can provide some good information, or is there anything else you'd like to add?
I think it's all right for chapter 12. I was just a little bit confused with all the what you call, all the bodies that determine the principles and everything like that in the chapter, but I went through into details and I think I'm all right,
Okay. Yeah, that can be a little confusing, very abstract, because you don't have direct knowledge of it sometimes. There's really only a few bodies of institutional knowledge on accounting that maintain all that and work through changes to it over time. I probably couldn't even recite all of them except for maybe one or two, one in the United States and one on the international side. They're not going to spend a whole lot of time on those bodies themselves, right? They're going to maybe ask you, they're going to ask you a question, maximum two about it. They'll focus more on the other principles of accounting.
Yeah.
Okay. So on chapter 12, this one really gets you looking at the very end, and then we work towards it as we go throughout the semester. And it's all about cash flow. One of the most critical aspects of any business is the resources you need in order to buy something, to sell something, to ship something. It's all comes down to cash in one sort of another. And so analyzing your cash flows is an important aspect of the business. Even though we may do accounting in accrual instead of cash, we tend to convert that back to cash to see where we're standing at any given time. Now, in my full review, in my short review, I go over these basically, but they're really broken down into three different areas. And when you look at how they develop these financial statements, you can look at cash flows from operating being almost directly associated with your income statement, your profit and loss, because that's your operating aspect of the business. Now, it ties in some pieces of the balance sheet, which are mainly on the, if you will, the short-term assets, the current assets, and the current liabilities, because you're using accounts payable or you're using salaries payable as your account where transactions come in and out on a regular basis. So they end up being operating, just like your bank statement is an operating account. Your inventory typically is an operating account. So all those kind of accounts flow within this operating side. Your investing tends to be things where you're buying a piece of equipment, right? Or you're buying something that has a long-term value for you. And so you're going to monitor your cash flows associated with that. And then your financing is usually associated with liabilities and equity. And it's typically something like a notes payable, notes payable that has a long-term duration, like a mortgage or something like that. Or it could be buying and selling stock. That's where those aspects come into play for financing. And you'll walk through those different types in this chapter, and we'll do that together here. So your statement of cash flows, right, really tells you beginning balance of cash, all the changes during the period that you're looking at. It could be a year long, it could be a month long. What's the period, all the changes in cash flows, and then what your ending balance is for that period. So you got beginning, changes, and ending values. I'm going to walk through this one pretty quickly because the operating activities. So once again, production and purchase of inventory, goods and services to customers, and expenditures to operate the business. This is really the key definition here. And you notice how it says net income, so it goes back to the income statement. And this is a nice little flow of money. You always have to start generally a business with some level of cash. Even though you might have let's say a talent, arguably you spend some money on that talent one way or another. I don't know how you did it. Even if you're gaming, sometimes people spend money on the game itself, and then they create videos and whatnot of them gaming and make money off it. Well, generally speaking, that starts off with a cash flow. Now, in this case, it talked about inflows, where you have sales from customers, receipts of money of one sort or another. You operate your business, and then you have some cash outflows, which go out towards salaries, operating expense, taxes, interest, and supplies, cost of supplies. That's all your operating activities. On your investing activities, once again, this walks you through the different types of activities, which I largely mentioned already, right? You have your notes. Well, I see investing. You have your long-term investments, you have your plant assets, and anything really tied to those in terms of outflows. And that might be long-term investments, short-term investments, selling or buying and selling those. On your financing side, you got your treasury stock, long-term debt, contributions from owners, right? And then you pay out dividends. Sometimes you purchase treasury stock. We have some withdrawals by owners, which could be similar to a dividend, but slightly different. And then you have payoff of your short and long-term debt. So those will give you some good views of what those activities are within those different cash flows. And then they kind of give you a nice little view for what is linked to what. All right, so your operating cash flows are right here. And then I think what they're looking at is usually investing is on these current assets, and your financing is on these longer term. Let's see, does it say that in here? Not really. Oh yeah, they do mention current liabilities. So I'm not sure how they're tying these together, what the color coding is. Oh, this must be just for the operating side of things.
Yes.
Oh, here it is. I can read it now. I should have taken English 101 when I started this class. Operating cash flows. Now I get this exhibit. Operating cash flows are largely impacted by current assets and current liabilities, whereas investing cash flows are long-term assets and financing cash flows are long-term liabilities and equity. That's what this is doing in terms of the balance sheet impacts to cash flow. Okay. Format. Now, the format of the statement of cash flows follows a similar format to others, where you have your company name, the name of the report, and then the period that it's associated with. And the period is a range of time, okay? Because you're looking at the beginning balance of one day, all the changes, and then the ending balances of another day. That could be a year, it could be a quarter, a month. Usually in typical financial statements, they come out with a year view of your cash flows. And you'll start out with your operating activities, your investing activities, and your financing activities with your net change. Then you have your beginning and your ending balances. Let's see. Oh, mercy. It's about time to go to bed for me, but that's okay. Here we go. Try not to slow down. You're just making a good impact. Okay, so information to prepare the balance sheet. So for a cash flow statement, you need your balance sheet information, your income statement, and sometimes some additional information to help parse some of the information between financing and operational activities or investing activities. But generally speaking, the accounts drive where they end up being, and it's pretty consistent from time to from month to month or period to period. Let's see. Okay, so if we went through this and we asked ourselves, okay, well, what is the purchasing of equipment for cash? This would be it's an asset, right? And it's usually a longer term asset. So this would be an investing activity. Cash payment for wages. Wages are operating specific type items, and they typically fall within current liabilities and current assets. So that would be an operating activity. Issuance of stock for cash. Stock is an equity item, and therefore it's a financing activity. Receipt of cash dividends from investments. This one might be a little tricky because you might first think, okay, it's a dividend, so it's probably financing, but in reality, you're receiving a dividend for an investment. And so that would take you into the investing area. There's some key words in here that you might, will trigger the differentiation between one or the other. Cash collections from customers. This is an operating activity because it's a revenue type of an activity. And so that would come here in your operating side. Note payable issued for cash. Note payable, this one might be a little interesting. I would say probably my first guess would be a note payable is a longer term thing, typically. So I might start out with financing. I might be wrong because they might consider that an operating, a short-term note, and so it may just be for cash to pay for, some ongoing operational expenses. So, but I'd first do financing, and then if I got it wrong, like on the quiz access, I'd move it right to operating. It's one of these two, but I'd start with financing. Cash paid for utility, that's an operating expense day to day. Just think about your own utilities. Those are things that just happen as a normal expense, right? Regularly paid out, short-term type stuff. Cash paid to acquire investments. Once again, that's probably an investment type of an activity. Cash paid to retire debt. Debt is going to be a long-term liability, so I put that under financing. Cash paid to cash received as investment on interest on investments. This would be investing activity. Cash received from selling investments, once again, an investing activity. And then cash received from a bank loan. Generally, this is going to be a long term, so I would start out with financing. Let's see if I got anywhere close to right. Investing, operating, financing, yep, operating, cash, oh, D, interesting. Cash received of cash dividends from investments. I said that was an investing activity, but this one is saying that is an operating activity. So it's, why would that be? Cash receipt of dividends from investments. Oh, probably because it's going directly into your bank account, which is a operating account. It's not going to parse it out from the fact that it was an investment. It's just gonna get buried in your bank account, and so you're never really gonna. And it's going to show up on your income statement because it's going to be an other income, and or maybe it could be like an interest, other interest or income. And so that's going to come from your net income, and therefore your income statement, and therefore it's an operating activity. Cool. Cash collections from customers. That one was operating. F was note payable issued. See, longer term. So at first I was okay with that one. So I missed one and I got the next one. That's good. Cash paid for utilities. G, operating. H, acquired investments, investing. I, financing. J, interest on, okay, once again, cash received as interest. Oh, I think I did this one right. No, I didn't. I probably did this as investment. And once again, this is hitting the bank account and with no real tie back to an investment, and it's cash. So it's an other income. It's an interest income entry that'll show up on your income statement. And so that's your operating. Okay, cash received from selling investments. That's an investment activity. and then cash received from a bank loan. Financing. Okay, so 2, 4, 6, 8, 10, 12. So I got 2 wrong out of 12. That's not bad. 80%-ish. You know, so I think that should help you kind of walk through some of the thought process behind allocating those to the different types of cash flows. Any questions there?
No, I think that one is all right. Yeah. It's just a more like revision from the last course.
Yeah. Yep. Yep. All good. I'm glad hopefully this will ring a bell if you've taken 101 or some other form of the accounting cycle, business cycle. Okay, indirect and direct methods. Now, I think, if I'm not mistaken, they're going to walk you through primarily the indirect method of doing cash flow, which means that you start with a net number, net income, and then you do variations from net income to come to the bottom line. The direct method is a little bit different. It starts off with cash receipts, operating cash payments, the ins and outs of actual cash, and then it makes adjustments from there.
Yes.
So they're going to focus primarily on the indirect method on this. Okay. And you can see why. Almost all businesses use the indirect method. The direct method is just a little, even though it sounds simple because it says direct, it's actually not as simple as you think. So most folks go with the indirect method because you can start out with net income, which ties to your financial statement. It gives you a nice, concise number to start with. And then, as you'll see here, right, see net income starts out with net income. That flows to, where'd it go? There we go. Starts out here with your net income on your income statement. And then it makes some adjustments based on typical operating accounts, right? So your depreciation expense will look at your, actually it'll look at the income statement and pull out the depreciation expense. And it'll pull out other things that aren't associated with cash related items. And so it'll pull those out, but then it'll do changes in the account balances. So let's say on accounts receivable, at the beginning of the period, you had, let's say, $100,000 in accounts receivable, but at the end of the period, you have $120,000 in accounts receivable. Well, that's an increase in accounts receivable, which actually suggests you didn't, an increase in accounts receivable means that you've extended credit to clients, right? And so you've added $20,000 in receivables, which is $20,000 less in cash that you've received as compared to what you show on your financial statements. And so that's why these changes in accounts is what you're focused on. Any increase in an asset account, depending on the type of it, actually shows a decrease in cash, and just the other way around, sometimes a decrease in the balance suggests an increase in cash. And so you go through those and you work out those differences and record them so that you come up with a net operating activity cash flow. That's why it's called net. Start out with the net income, work through changes and come to a net amount. Walks you through the different things that don't affect cash, like depreciation, for example. You buy an asset a year ago, but you're expensing part of it this year, right? It's not really cash flow because you bought it a long time ago. Yeah. So you have to pull that out of your net income to increase essentially your net income, because that doesn't impact cash. Plant asset, gain and sale or loss of any plant assets that show up on your income statement. That's not an operating activity, that's a investing activity. And so you have to take it out of the net income. And then let's see, retirement of gain on retirement of debt. So maybe sometimes you retire debt and you pay less than what you actually owed. And so sometimes that'll get you a gain. Well, that's not a real gain because you didn't get any cash for it. You just didn't pay it back. You didn't pay back a certain amount. So instead of an outflow, it's just a negative flow, even though it shows up on your income statement as a gain, which is an increase to income. So you have to take that out of income as well. So that's why you look, generally speaking, at your income statement and you look at the accounts to verify that they're all cash-based transactions. If they're not related to cash or they're not related to operating activities, then you pull them out as an adjustment in the operating section. Now, that's all good and dandy if I say that, but then this is where you see the actual adjustments, right? You see the account balance at the beginning, the account balance at the end. It's actually a $20,000 increase, right? So that's why that's why they decreased cash flow by $20,000. In this case, it's inventory. So you had a $70,000 balance, and at the beginning, at the end, you had 84,000. So that's $14,000 increase in your inventory, which actually means that you had you had more cash go out than what's showing up on your income statement. So that's a $14,000 decrease in cash. Prepaid expenses, if it goes up, you paid $2,000 more on expenses that haven't been recorded yet. And so that's a $2,000 decrease in cash. Accounts payable, this one actually went down. This is the inverse of accounts receivable. So when your accounts payable goes down, it's actually an increase in cash. And so actually, no, it's a decrease in cash because, sorry, when it goes down, it's a decrease in cash because you actually paid more out than you originally had. So $40,000 original balance is decreased to $35,000. So it's $5,000 more in cash outflows. So you have to subtract 5,000 from the income. Interest payable is the same thing. It went down by 1,000. This is on the liability side. So a decrease in liabilities results in a decrease in cash flow. And it'd just be the opposite. So an increase in the liability would suggest an increase in cash flow somewhere. Income taxes payable, saying this one is just the opposite. This is, like I said, a liability side. So you originally had $12,000. You recorded $15,000 in expense. And so this is a $22,000 payable. Well, you don't have to pay those taxes until later. It's almost like, you get your tax refund next year, but you paid them this year. Well, the cash flow happened, but in this case, it didn't happen. You just recorded the expense. And so it shows up on the income statement, but it's not a actual reduction in cash. It's an increase in cash until you have to pay it out. So if you had paid that $22,000 out like in March, well, you go from 22,000 now to 0 in March, and that would be the decrease in payable and therefore a decrease in cash. Okay, so I'll walk you through how you come up with net operating activities in the indirect method. And then it walks you through an example. So maybe we should work this out. Why don't we do that? 7:41, I got time. We can do this. So what I like to do when I'm working through these things is go ahead and pull the information over. Oops. Just copy this. And I'll put it over here. Paste. Oh, it's not gonna let me do it. Oh well, fine. So we will construct a cash flow statement. So this is for, I don't know, company X, Y, Z, and it's a statement of cash flows, and it's going to be dated for the current year ended December 31st is my guess. For the year ended December 31, 2000 something, call it 23. Okay. So we'll start out with that. I won't do the formatting here. So we have cash flows from operating activities. We have cash flows, from investing activities. And we will have cash flows from financing activities. Usually have a net change and then a beginning balance and an ending balance. Okay, that kind of gets us started there. We know our net income is where we start. On this one, we'll put it right here. Actually, we'll put it right here. This is $20. Now we have to adjust this for anything. First adjustment for non-cash activities. Let's just go ahead and insert this, insert a row. I'll hit F4 and that actually does the same thing I just did again a couple of times. And so we have depreciation expense is one item, right? Depreciation expense. So we need to add that. Oops. Doesn't help if I do that. There we go. Okay, so we're going to add back. What is that? $30. And then adjustments for account changes. So we have, what is it? This first one, selected balances, accounts receivable, current year, prior year. So this is a decrease. Let's do this. A decrease in accounts receivable. And that is, so a decrease in accounts, actually that is an increase. Current year, prior year, that's an increase, isn't it? My bad.
$2.
Increase. So it's an increase. Actually, you know what? The easiest way to do this, let me do this real quick. Let's find another place to do this. Let's do this in sheet. So, I want to do this in one place so you guys can all see this. So let me make this a little bigger. Make this, let me take this out. And let's just do, let's take this AR, inventory. Why do I keep on doing that? Inventory. Okay, accounts payable, whoops, accounts payable, salaries payable, and we've got interest payable. Okay, so we'll do this backwards though, prior and current for a variance. And I mean, so that I can see this later on, cut this, put it back over here, insert. So we got the variance, we got prior, current. So prior was 10, 9, 11, 3, 0, right? Current is 12, 6, 7, 8, 1. So the difference is, so if I take current minus prior, will give me the change from year to year. If I copy this and paste this down, so this shows an increase, this shows a decrease, decrease, increase, increase. Okay, so now we can write this out. So increase in accounts receivable, that is actually a reduction. Reduction minus 2, right? We have a decrease in inventory. And so because inventory is an asset account, if it decreases, it actually is an increase in cash. So we're going to do that as a 3. And then we have it's actually a decrease in AP. A decrease in accounts payable means that we paid less in cash. So that actually is an increase in cash. We have a increase in salaries payable. And so if it goes up in salaries payable, that means it's a decrease in cash. No, it's the other way around. I always have to think through this again. So a decrease in accounts payable, that's right. So an increase in salaries payable means that we paid less in cash, because increase in salaries payable, less in cash. So that's a 5. If I go back to accounts payable, decrease in accounts payable actually means we paid more. So it should be. So the way you're seeing this is that on the liability side, you're just matching the numbers. If they increase or decrease, it's fine. On the asset side, it's just the inverse. A decrease in inventory is an increase in cash, and a increase in AR is a decrease in cash. Okay, let's move this one down a couple. And so interest payable, nothing than prior year. This is a liability, so it's going to be the same thing. So it's an increase in interest payable. Increase is the same. So our net operate cash from operating is going to be the sum of all these items here. Now the real question is, did I get that right? So I think they're just focused on this first, on the operating cash flow section. So let's see. Oh my goodness, I got it right. So 20 plus 3 minus 2 plus 3 minus 4 plus 5 plus 1, 33. Those are your net operating activities.
Crazy.
Any questions?
No,
I know I go through that pretty quick, so.
And so I will catch up with it because I watch everything after and make sure I know how to do the tricks, getting all those validation things right.
So this is probably, even as I was talking through it, I get jumbled up back and forth, and so you have to, probably the cliff notes of this, the short version is that if it's an asset, the variance 1 year to the next is going to be an opposite adjustment, right? So an increase results in a decrease in cash. A decrease in the account balance represents an increase in cash for the cash flow. For your liability accounts, it's 1 for 1. It's the exact same. So if it decreases on the account balance, it decreases for cash. If it increases on the account balance, it increases in cash. Okay. And that should give you a nice, quick kind of cheat sheet, if you will, on how to approach the net cash flow from operating activities. All right. Investing, I'll walk you through those. These are pretty straightforward. It's just account balance changes on these, and it'll walk you through pretty much the same thing that I just did. Cash received from a sale of a factory, that's an increase in cash. An increase in cash. It's pretty much, no, I can't even talk right now. It's pretty much exactly what you think it would be. If you sold something, you get cash, that's plus. If you paid for something, it's a negative, right? Sale of a long-term asset, it's an increase. Sale of land, it's an increase. So you're just calculating, and you're really noting what those changes are in increases in investing activities or decreases. When you get to financing, it's pretty much the same thing as well. You're looking at certain types of transactions that are long-term liabilities equity transactions. And then you're going through and you're identifying them right here. So you receive cash from the issuing stock. That's an increase in cash, right? Because you received it. If you paid something out, it's going to be a decrease, and it's all related to either long-term notes or equity type
And
transactions.
yeah.
Okay, so in the same example, you know, if I
Okay,
had
I'll check it
everything,
later.
I'm sorry.
Yeah. Okay.
Yeah, so in my example, we had calculated this, and then all you do is end up adding
Okay.
these for a net increase in cash
Okay. Okay.
with the prior and current year. Okay,
Okay. Okay. Yeah. Yeah. Bye.
so that's how that works.
Okay. Okay.